Listen, I want you to imagine a person standing in their own kitchen at 6 o'clock in the morning holding a piece of paper they do not understand. And I want you to understand that this paper is going to cost them $15,000 this year for the unforgivable act of spending their own money. This person is 71. They worked for 43 years. They did everything the guidance suggested. They maxed out their retirement accounts. They never carried a credit card balance. They drove the same reliable car for 19 years. And now they have $2.5 million sitting in a traditional IRA, and they have just learned that they are not actually permitted to touch it without setting off a silent alarm wired directly into the United States Treasury and the Centers for Medicare and Medicaid Services. The paper in their hand is a notice from the Social Security Administration dated this year, 2026. And it informs this individual in the flat bureaucratic language of a parking ticket that their Medicare Part B premium is no longer the standard $22.90 a month because of something they did 2 years ago, something they didn't even know was a misstep. Their premium has been adjusted upward. Adjusted, that's the word they use. Like they're tuning a piano. They are not tuning a piano. They are reaching into the bank account of a 71-year-old person and taking more. Because last year, this individual decided for one brief, shining moment to actually live like the millionaire they spent their entire life becoming. Here's what this person did. It was so simple, so innocent. 2 years ago, this individual and their spouse decided they were finally going to do it. The dream trip, the Mediterranean cruise they'd been promising each other since 1987. A new car because the old reliable one had finally surrendered, some money to the grandkids. They added it up and it came to about $180,000 on top of their normal living expenses. And this sensible individual looked at their $2.5 million IRA and thought, I have earned this. This is what the money is for. So they called their brokerage, withdrew what they needed, and they and their spouse had the best year of their retired lives. And then the bill came due, not the cruise bill that was paid, the other bill. The invisible one, the one mainstream financial media with all their cheerful segments about enjoying your golden years somehow never gets around to explaining. This should make you upset because what happened to this individual is not an accident. It is not a glitch. It is a trap, a specific engineered, mathematically precise trap that I call the ceiling surcharge trap. And it is built into the architecture of the American retirement system for one reason only. To ensure that the moment a retiree tries to enjoy the wealth they accumulated, the system can reach in and skim it back off the top. They let you save it. They just don't want you to spend it. And if you spend it in a certain way, they make you pay an extra cost for the privilege of accessing your own savings. I have spent years pulling apart these mechanisms, reading the Internal Revenue Code section by section, the way a detective reads a scene. And the ceiling surcharge trap is one of the most elegant pieces of legally structured cost recovery I have ever documented because it disguises itself as your own choice. It convinces you, the retiree, that you simply don't want to spend money anymore. It whispers that you've become frugal, that you've lost the taste for travel, that modest living is just what happens when you get old. It's a misperception. You didn't become frugal. You were trained. You were conditioned like an animal that stops touching the fence after it gets a warning enough times to stay inside an invisible income ceiling, and you never even saw the wire. And before I show you exactly how the wire is laid, exactly where the voltage comes from, and exactly how the genuinely wealthy step right over it without a scratch, do me one favor. Smash that like button. I know everybody says it, but here's why it actually matters in 2026. There is an algorithmic shadow ban on senior financial truth. Content that tells retirees how the tax code actually affects them does not get promoted. It gets buried. The only thing that drags it back up the rankings is engagement. And a single tap from you tells the machine that this information deserves to reach the next person before they make the same $180,000 misstep. So hit it. Do it now, then come back, because this gets more serious before it gets better. Now, let me show you the data that started this whole investigation because it's one of the strangest numbers in American economics. And once you see it, you cannot unsee it. The Federal Reserve runs something called the Survey of Consumer Finances. It is the most authoritative look we have at how American households actually hold and spend money. And buried in the retiree spending distribution is an anomaly so bizarre that when I first saw it, I assumed it was an error. Roughly 3 out of 4 millionaire households in retirement, households with a verified net worth well over $1 million, restrict their annual spending to a narrow band between about $70,000 and $120,000 a year. 3/4 of them, people with $1.2 million in the bank, voluntarily living on the same budget as a comfortable upper-middle-class family that has a tenth of their wealth. Now the financial press has a ready-made explanation, and it's the one they feed you on every morning show. They say retirees naturally become frugal, they lose the desire to travel, their tastes simplify, they've raised their kids, paid off the house, and they just don't want for much anymore. Isn't that pleasant? The wealthy elderly have simply discovered the serenity of wanting less. It's misleading. Complete and total misleading narrative. And I want to tell you what's really happening. Because the clustering of millionaire spending in that 70 to 120,000 band is not a psychological accident. It is not serenity. It is a defensive crouch. It is 3/4 of America's wealthy retirees flinching away from an invisible electric fence, and almost none of them can even articulate what they're flinching from. They just know that every time they reach past a certain income number, something happens to their costs the following year, and so they learned slowly and painfully to stop reaching. That number, that ceiling they're all crouching beneath, is the IRMAA threshold. And to understand the trap, you have to understand IRMAA. So let's get into the evidence. IRMAA stands for the Income-Related Monthly Adjustment Amount. Write that down. Burn it into your memory because this is the actual name of the thing that's affecting you. And one of the first signs that someone doesn't understand the system is that they call it by some made-up name. It's not a surcharge tax. It's not some vague Medicare fee. It is the Income-Related Monthly Adjustment Amount established under the Medicare Modernization Act back in 2003 and expanded under the Affordable Care Act in 2010. And it has been quietly recovering money from higher income retirees for over 20 years now through Republican and Democratic administrations alike, because once a revenue mechanism like this gets built, neither party ever has the slightest interest in adjusting it. When you turn 65 and enroll in Medicare, you pay a monthly premium for Part B, which covers your doctors and outpatient care, and another for Part D, which covers prescription drugs. For 2026, the standard Part B premium is $22.90 a month per person. That's the number a normal beneficiary pays. That's the number our individual thought they were paying. The government, in theory, covers about 75% of the actual cost of your coverage, and you cover the remaining 25% through that premium. But here's the part they hide. If your income climbs above a certain level, the government decides you should pay a bigger share of those program costs, not 25%, 35, 50, 65, 80, 85. And the way they collect it is by bolting an IRMAA surcharge directly onto your monthly premium. So your Part B premium climbs tier by tier depending on how far over the line your income went. Now stay with me because here is the single most important point in this entire video. The income they use to decide your IRMAA is not your income from this year. It is your income from 2 years ago. There is a 2-year look back. Read that again. Your 2026 IRMAA premiums are determined by your modified adjusted gross income, your MAGI, from your 2024 tax return, the year 2024. The thing you did 2 years ago is reaching forward through time to set your healthcare costs today. This is the part that affected our subject. They took that $180,000 withdrawal, and at the moment they took it, nothing happened. No alarm, no penalty. They thought they'd gotten away clean. And then 2 years later, like a delayed action charge, the IRMAA detonated. The Social Security Administration looked back at their tax return, saw the spike in their income, and adjusted their premiums upward for the entire following year. That's the 2-year fuse. By the time the consequence arrives, you've forgotten the action that caused it, and you certainly can't undo it. So, what counts as income for this? Your MAGI for IRMAA purposes is your adjusted gross income plus any tax-exempt interest like municipal bond interest. And your adjusted gross income includes the big one for retirees. Every single dollar you withdraw from a traditional IRA or a traditional 401k, every dollar. It includes the taxable portion of your Social Security. It includes interest, dividends, capital gains, rental income, pension payments. Almost every normal source of retirement income that a retiree would naturally tap pours straight into the MAGI bucket. And when that bucket overflows past the threshold, IRMAA fires. And I need you to understand the most significant feature of this whole structure. The thing that separates IRMAA from a normal tax. It is not a gradual slope, it is a cliff. With your regular income tax, if you earn $1 into a higher bracket, only that $1 gets taxed at the higher rate. That's how marginal brackets work, and it's actually merciful. IRMA does not work that way. The instant your MAGI crosses a threshold, even by a single dollar, the entire higher premium applies. A retiree whose MAGI lands $1 over a bracket line pays the exact same inflated premium as someone who blew past it by $30,000. There is no partial credit. You either stay below the line or you fall off the cliff, and the rocks at the bottom are made of money. Let me give you the actual 2026 brackets, because vague talk about thresholds helps no one. And the genuinely wealthy know these numbers cold, the way you know your own birthday for a married couple filing jointly both on Medicare. Here's the 2026 map based on your 2024 income. As long as your MAGI was $218,000 or less, you're safe. You pay the standard premium, the $2,290 each, no surcharge. That's the ground floor. That's where you want to live. The instant your MAGI crosses past $218,000, you fall to the first IRMAA tier, and your Part B premium per person jumps by about $81 a month. Cross past $274,000 and you're into the next tier, paying double the standard rate. Cross $342,000, you're paying 2.6 times the standard. Past $410,000, 3.2 times. And at the very top, for couples with a MAGI of $750,000 or more, you pay 3.4 times the standard premium, which works out to a Part B premium of close to $690 a month per person, plus a Part D surcharge stacked on top of that. For a single filer, the cliffs sit at half those numbers. The first hits at $109,000 of MAGI, then $137,000, then $171,000, then $205,000, then the top tier at $500,000. Same brutal cliff structure, just at lower elevations, which means single retirees, including a significant number of widows who lost a spouse and suddenly find themselves filing alone, hit these walls at far lower income levels than they expect. Now, do you see the $70,000 to $120,000 spending cluster differently? Of course you do. The wealthy retirees of America are not frugal by temperament. They are clustering their visible income just below that $218,000 joint threshold. And once you back out their Social Security and their normal expenses, the spending that shows up in the Federal Reserve data lands right in that 70 to 120 band. They're not living small because they want to. They're living small because they're concerned about the cliff, and most of them don't even have the vocabulary to explain what they're concerned about. They just feel the fence. I want to hear from you on this one because I know you felt it too. Tell me in the comments. Have you ever held off on a big purchase, a trip, a car, a gift to your kids purely because you were concerned about what it would do to your costs the next year? Have you ever left money sitting in an account? Money you earned, money you're entitled to, because some instinct told you that pulling it out would trigger something you didn't fully understand? Drop that field report below. I read them, and I want to know how many of you have been quietly affected by this fence without ever being told it was there. Now, let's talk about the core issue, because there is one and it's not a person. The core issue is the structure itself. Specifically, the way it impacts you multiple times for the same act, and then, just to be thorough, takes away the consolation prizes too. Let me walk you through what really happened to our retiree dollar by dollar, because this is where the cost becomes visible. And I'm going to be honest with you about the math in a way a lot of the alarmists out there are not, because the truth is serious enough without exaggerating it. When this individual pulled that money to fund their lifestyle, the withdrawal from their traditional IRA was fully taxable as ordinary income. Let's say their baseline retirement income, the Social Security plus a small pension plus normal IRA withdrawals, was already putting their MAGI around $100,000 comfortably under the cliff. Fine, safe. But then they stacked that $180,000 lifestyle withdrawal on top. Now their MAGI for the year rockets to roughly $280,000. They have not just crossed the first IRMAA cliff at $218,000, they have sailed clean past it and the second one too, landing their couple squarely in the tier where they pay double the standard Medicare premium. So here comes the first hit, the IRMAA hit. Both spouses are on Medicare. For the year their income gets caught, each sees their Part B premium inflate. In that double the standard tier, the surcharge alone runs into several hundred a month per person. And when you add the Part D surcharge and multiply by 2 people across 12 months, you're looking at thousands of dollars in pure IRMAA surcharges. Call it somewhere in the range of $3,000 to $4,000 for the couple for that year. Money that buys them absolutely nothing extra. Same doctors, same coverage, they just pay more because their income number got too big. But the IRMAA surcharge, as significant as it is not even the biggest part of the impact. Here's where I have to be straight with you. The bigger hit is the ordinary income tax on the withdrawal itself. That $180,000 withdrawal didn't just trip IRMAA, it got taxed as ordinary income. And because it stacked on top of their baseline, a huge chunk of it got taxed at the higher marginal brackets. Tens of thousands of dollars in federal income tax, much of it at rates they could have avoided entirely if they'd structured their money differently. Combine the elevated brackets they got pushed into with the IRMAA surcharges riding behind, and the all-in cost of accessing that money the wrong way lands well over $15,000 in pure excess cost. Not the cost of the cruise, not the cost of the car, the cost of the misstep, the toll they paid at the gate just for the privilege of reaching their own savings. And now the most difficult twist, the one almost nobody talks about. Remember the senior bonus deduction in 2026 under the One Big Beautiful Bill that became law in 2025. There's a temporary bonus deduction for seniors 65 and older up to $6,000 per qualifying senior. $12,000 for a couple where both qualify. It's a real benefit stacked right on top of the standard deduction, one of the few genuine gifts in the current code for retirees. But here's the knife. That deduction phases out as your income climbs. For a married couple, it starts shrinking once your MAGI passes $150,000 and it vanishes completely by $250,000. So when this individual blew their MAGI up to $280,000, they didn't just trigger IRMAA and pay higher income tax, they also vaporized their entire senior bonus deduction. The system gave them a gift with one hand, and the moment they spent their own money, snatched it back with the other. 3 impacts for one act: the income tax, the IRMAA surcharge, and the loss deduction, all detonating off the same trigger. That is the core issue, not a person. A machine engineered so that visible income above a certain ceiling triggers multiple overlapping costs at once, each one feeding on the same withdrawal, each one quietly transferring your wealth back to the system you already funded for 43 years. And here's the part that should genuinely concern you. If you are out there right now shrinking your own life, declining the trip, keeping the old car, telling yourself you don't really need it because somewhere deep down you're concerned about what a big withdrawal will do to your costs next year, then understand what's happening. You are letting the government's invisible income limits dictate the shape of your golden years. You worked your whole life to build a vault, and now you're standing guard outside it, too cautious to open the door, while the people who designed the locks benefit all the way to the treasury. This is exactly the moment to do something about it for someone you care about. Share this video with one retiree you value, not tomorrow, today, because there is a person in your life, a parent, a sibling, a friend from the community, someone sitting on a healthy nest egg and quietly flinching away from spending it. And one conversation now, one forwarded video, can save them $15,000 or more later. One conversation, that's the price of admission to keep someone you care about out of this trap. Send it. Now, the suits want me to tell you that this isn't financial advice. It's a survival guide for an unguarded vault. Consult a professional if you still trust the people trying to tax your Social Security for the 3rd time. There, disclaimer delivered. Now, let me show you how the genuinely wealthy step over this entire trap without breaking stride. Because the strategy is real, it's legal, and once you see it, you'll understand why the cluster in the Federal Reserve data exists. Here is the secret. And it's so simple it will make you frustrated. No one told you. The truly wealthy retirees, the ones who actually spend $200,000 a year while showing a tax return that looks like $100, are running a structure I call ghost income. They've figured out that the government can only see certain kinds of money. Some income is visible to the IRS, the Social Security Administration, and the IRMAA calculation. And some income is for these purposes completely invisible, legally invisible, tax blind. The whole game is funding your real life out of the invisible bucket, while keeping your visible bucket capped just below the cliffs. Your visible bucket is the stuff that pours into MAGI, traditional IRA, and 401k withdrawals, pension income, the taxable portion of Social Security, interest, dividends, and capital gains in your taxable accounts. Every dollar from these sources shows up. It counts. It pushes you toward the cliff. Your invisible bucket is the money that, by the design of the tax code itself, does not enter your MAGI at all. The crown jewel is the Roth IRA. Under Internal Revenue Code, Section 408A, qualified distributions from a Roth are entirely tax-free, and critically, they do not show up in your adjusted gross income, which means they do not show up in your MAGI, which means they are completely invisible to the IRMAA calculation. You can pull $50,000, $100,000 out of a Roth in a single year. And as far as the IRMAA cliff is concerned, that money does not exist. It is a ghost. The same broad principle applies to certain properly structured permanent life insurance arrangements, where you access cash value through policy loans that aren't treated as taxable income, and to the basis you withdraw from regular taxable accounts, the original principal you already paid tax on, which isn't taxed again when you pull it out. So here's how the wealthy actually run it. They cover their baseline lifestyle, the regular bills, the groceries, the property taxes with visible income, Social Security, plus a measured amount of traditional IRA withdrawals carefully calibrated to land their magi safely below that $218,000 joint cliff. They might deliberately keep visible income right around $100,000. Comfortable, under the radar, no IRMAA surcharge, lowest possible Medicare premium, senior bonus deduction, fully intact because they stayed under the phase out. And then when they want to actually live, when they want the cruise and the car and the gifts to the grandkids, they don't touch the traditional IRA for that part. They reach into the invisible bucket. They pull the extra $80,000-$100,000 from the Roth. And because that Roth money is tax blind, it produces zero additional MAGI. It doesn't nudge them 1 inch toward the cliff. Their visible income still reads $100,000 on the tax return. Their Medicare premium stays at the rock bottom standard rate. Their senior deduction survives. And they spent $200,000 this year while looking to every government computer that's watching exactly like a modest $100,000 retiree. That is ghost income. That is the strategy. That is why 3 out of 4 millionaire households show up in that frugal-looking spending cluster, because a meaningful share of them aren't actually frugal at all. They're just running their luxury through the invisible pipe where the cameras can't see it. Let me run the head-to-head comparison the same couple 2 ways. So the math is undeniable. This is the calculation the wealthy do at their kitchen table every December. And you're about to do it too. A couple, both 71, with $2.5 million in traditional IRA. Scenario A, the way it actually happened. They fund their $180,000 dream year entirely out of the traditional IRA on top of their baseline. MAGI explodes to around $280,000. They blow past 2 IRMAA cliffs into the double premium tier, paying thousands in surcharges across both spouses for the following year. They pay tens of thousands in ordinary income tax on the withdrawal, much of it at elevated marginal rates. And they completely lose their senior bonus deduction, which evaporated past $250,000 of MAGI, total damage from the structure alone. The pure excess cost the toll at the gate comfortably over $15,000 money they directed straight back to the system for the simple act of spending their own savings, the unstructured way. Now, scenario B, the way the wealthy do it, same couple, same dream year, same $180,000 of actual spending, but this time they pull $100,000 from the traditional IRA, which combined with Social Security keeps their MAGI parked safely below the $218,000 cliff. No IRMAA surcharge. Standard Medicare premium, the lowest there is. Senior bonus deduction fully preserved. and the remaining $80,000 of lifestyle, they pull it from the Roth tax on that $80,000 zero. IRMAA impact zero. Effect on their senior deduction zero. Same cruise, same car, same gifts to the grandkids, and the toll at the gate this time is essentially nothing. Same life, same spending. One structure pays a $15,000 extra cost, the other pays nothing. And the only difference is which bucket the money came out of. That is the whole strategy, and there's nothing improper about it. Nothing aggressive, nothing that requires an offshore anything. It is simply knowing that the government can only see certain colors of money and choosing to spend the colors it can't see. This is the kind of thing you save. So save this video to your private library right now because this is your survival manual for the day the letter arrives. The day you're staring at your own withdrawal decision and you need to remember which bucket to reach into first. Tap Save. Future you, the one holding a notice from the Social Security Administration, will be grateful that past you kept the manual. Now I want to give you the action plan because understanding the trap is worthless if you don't change your behavior. And I want to be exhaustive about the steps because the details are where retirees stumble. Step 1, map your visible income against the 2026 IRMAA cliffs. Sit down with your last tax return, find your MAGI, then find the cliff that matters for you, the 218,000 joint number or the 109,000 single number, and figure out exactly how much headroom you have between your normal income and that line.